Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you this strategy of the week update here for April 7th, 2022. It's good to be back here. It feels like this last week has been a wild string of events, obviously from the big announcement of the birth of my first born child and my son. Daniel M. Hussey III. So that's pretty exciting. Talk about Black Swan after Black Swan this year. Russian, invasion of the Ukraine. All the other crazy stuff that occurred last year and into this one, and then now this last week, right into what is really, I think, the starting pistol. And I've said this before. This is the goalpost, the starting point, the starting line, if you will, for the next several months, and for what usually sets up as a trend, and at least what did last year. And we'll take a look at that again here today, because I think that's one of the big important things to consider is where were we last year? What did charts look like? We have a very similar situation with exports, those tightening carryouts. What are the spreads saying, right? That's actually where I want to begin here today. Oh my goodness. So maybe we can't go that large. Give me a second while I figure out my application settings here and actually maybe just make my font sizes just large. There we go. So now I can at least go maximize sell. Okay, so let's take a look here very quickly. This is the July-November bean spread. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But, you can always get in touch with me over here at Zaner at 312-277-0110. Shoot me an email or message here on Facebook. We're always here to talk about trade plans and how to turn these ideas into actual trading strategies, because there's an art and an art and a craft to trading, right? The art is that intangible thing that you can't really teach. It's risk management skills. The craft is knowing technicals, things that everybody can be taught because they're the same for every situation. But understanding good risk management and turning that into and translating into a trade plan, that is where that's where things get confusing sometimes, and oftentimes we make the mistakes as traders. With that being said, we started off the month of April by making new lows here in the July node, the old crop, new crop calendar spread. This spread is technically and fundamentally significant this time of year because it starts to unravel or usually showcase some form of trend that we're looking to unfold for the rest of the year. If we're in highly inverted markets as we are right now, where that new deferred crop is at a discount to the near term or that old crop. At this point, $1.62 and as much as $2.03 wide there between the crop seasons. When we have this much of an inversion in the market, we really are still in a bullish type of environment where we're expecting carryouts to continue to get lower if we have any form of because exports have been strong, because the demand has been strong, and that's okay. That's there. That's unquestioned this year. I see no reason, and I don't think anyone, any analyst anywhere is questioning Chinese, questioning European demand, questioning even demand from South America right now for U.S. production to meet some of the stop gaps in their own shortfalls this last year. Because remember, South American production hasn't been that great, and we're starting to see that unfold and starting to see the reduction in acreage. In fact, we're looking generally, the trade is looking for into this Friday's report, we're looking for a reduction in South American production out of the USDA. And that really just brings them more in line with what we've seen out of CONAB and other analysts or other, reports, right, from South America that the trade is probably already pricing in, and a good reason why we're seeing that support come in. While we saw some selling, some strong selling pressure here over the last couple weeks, I shouldn't say last couple weeks, the last week in the row crops, we found support at places that would justify, a seasonal trend beginning from here and otherwise heading higher. Now, the calendar spreads, I think, justify that. While we broke lower here, we're going to take a look at the 4-hour chart here for the July Nove calendar spread again. We broke below this trend line in this channel support that was around $1.80. That's fine. We made 3 waves down. Trend lines are made to be broken, and at this point in time, there's other technicals and other reasons to be bullish this chart. There's other reasons to think that we could continue higher, and new trend lines will form, right, if that's the case. So we probably have some kind of channel lower, beginning at this time. I think you can kind of find it here in this bull flag or this pennant type structure. This looks like 3 waves down. I don't like to read into technicals too much on spread charts, but I will, we will at least, identify the fact that there's been a very strong uptrend. Have we broken any kind of levels other than a trend line here to suggest that a top has formed and we're going to see bear spreading and a carry trade type market ensue? I don't think so. Mainly because we still have that fundamental fundamental bias from the marketplace, from having tight carryouts, from having strong demand, and going into weather markets in a year where we have drought conditions, generally speaking, across the Midwest and throughout the United States. So we need to see precipitation now prove itself into a time of the year when we don't necessarily want to see some rain, because obviously planting needs to be on time this year. But if we see any rain come in that pushes harvest back, we have a late plant, then no rain later in the year, and weather markets all throughout, you can see how there could very much, and of course, let's throw in maybe a little bit of a miss from production in South America. They've got big acres down there, but if weather doesn't turn out to be stellar and they don't get a big crop out of the second crop corn, the world is really going to be leaning on the shoulders of the United States production for corn and North American production, because, the breadbasket of Europe is also kind of on fire, if you will, and in questionable acres. I think wheat in the Ukraine is going to, and we'll touch on this later, has more of a chance of being harvested than other crops like corn and things that require a little bit more attention, because wheat is a weed and it will grow. You just throw it out in a field, not literally, but generally speaking, if you were to just do that with any crop, I think wheat would be the one that you'd bet on having the best success with, because it's just a grass, right? Obviously, to really maximize yield and what have you, it's not that simple. But if there's a will, there's a way with wheat rather than our other crops. However, we're at the crunching point, and I think we're starting to see wheat. Wheat is making a decision here on that spring planting of whether or not it's going to get going, and we're going to watch that spring wheat contract here into the new year, or into this next season. So, okay, let's get into the row crops, because I wanted to point out that we're still very much bull spread there in July no beans. Let's look at July D's corn, just for the sake of taking a look at maybe a bottom forming there. We've broke above trend line here that we've come back down to test yet again. We really sold off, and from $1 over, really pulled back here to test into kind of really this old range we were in, but we are staying over 30 cents over. We've basically made higher highs and higher lows through this whole progression, and that's what's important to watch for in these spreads, because the spread isn't very likely going to trend towards $1, $2, $5, $10 wide, right? There is going to be a point where the spread gets a little too wide and that deferred crop is just going to get dragged up. Historically speaking, too wide is $2-ish on a corn spread, and $2 to $3 on those beans. Those can go maybe a little wider in these inflationary markets that we need to be aware of. But for the time being, we've seen a very big setback, a break below trendline support in both of these markets. We're finding a new normal or a new bottom to maybe base from. And stepping out to the daily time frame, you can see how these markets are very much, at least in the, in terms of the July D corn spread, it's very bullish. We're remaining above even money, right? This is not your typical bear spreading market going towards full carry yet. We need to break below the contract low. Well, not the contract low, which is interestingly enough only 4 3/4 cents over. So this has never been under. Think about that. It's been inverted in its entire existence. That says something about this market. So long as we stay, generally speaking, making this series of higher highs and higher lows, month over month, week over week, I believe this is a market finding a new normal in this inflationary environment, because we have things going on this time around that we've never had before. This is the first time in the ethanol world in the corn post-ethanol world, where we have inflation affecting global markets on a real scale like this, at a time where, okay, there's a little bit of a conflict going on in Europe and Western or Eastern Europe, and certainly tight carryouts and strong demand. So there's a lot of interesting things and dynamics going on in that regard. Is it a new thing worldwide or for all time? No, we've seen a lot of this in the past, but it's certainly yay, the first time we get to go through it at these prices. All right, so let's take a dive here into the daily charts. I want to take a look here and begin with May beans breaking below that 18-day moving average here a few weeks ago and staying there, right? We touched on that, and I believe in our last report, or maybe sorry about that. Maybe one of our last videos, we talked about how it came down to it and it was holding above. Well, we went below it. We broke below that trend line. We came back up to test it as resistance. And now, let me refit this so that we can see kind of all of it. Hoping, bingo, done. It came back below those technical levels and then tested down to the 55-day moving average. 100-day moving average down around 1477.5 and 200-day down around 1390. You can see the daily RSI here. We came from we have not been overbought in the daily RSI here in the May beans since February, the start of February. We have been oversold multiple times. So that to me suggests that this market isn't necessarily done to the upside, right? It has. I'd like to see it go overbought here, and even in a bear market where you would be fading overbought conditions in a bear market. This is not the case. I think from a daily perspective, this is where you look at a market that's been fading those oversold conditions, and you're watching the bid support the market in those situations. And by the way, into very technical levels, not only here with the 55-day moving average at 1606, but also at the old supportive area here and our gap. If we look here back on into early or late February there on February 25th, we had a gap up from 1584 up to 1631, up to 1613, and it ran higher. We've come down to fill that area on the chart and rehold that area as support now, and 4 days later have tested and started trending and higher in a series of higher highs and higher lows. That's a bullish, very technical reversal. Now it's up to the bulls to push through the 18-day moving average, push through 50% retracements that we'll take a look at here in a minute, and reclaim this entire range back towards $17 and above. If it does, then we can talk about the breakout higher. And breaking out of this type of pennant structure in a move higher. Keep in mind, this is how October through April looks for this year. Remember when we went and looked at last year, what October through April looked like before. And by the way, we had overbought conditions in early March, overbought conditions in early February, and then basically a string of oversold conditions while the market went sideways below the 18-day moving average and held this 55-day. We tested the 55-day moving average. It's interesting how it came up to the market here, and this year we had to fall down to it. But from the 55-day moving average, the market then rallied through April and into the end of its life into May. Hitting finally overbought conditions, blasting $2 higher. If we see that similar type of price action out of the soybeans this year, you would expect the market to then if it heads $2 higher, we're talking towards 18 to 19 here in a big rally. But if it goes the same to the same the same extent of the move that we saw last year. The move from October through February or to highs here was about a $6 move this year. I'm putting things in relative terms. Last year, the move from October from $10 to highs there was at 14 was only $4. So, okay, so that means if we move $2 last year in a time of the year when we were moving $4 before, and we moved $6, maybe we move $3 higher this year. Just saying. If we see that big blow off kind of rally, I don't see why that couldn't be the case. And then on top of that, you get weather markets into and through June and July. I don't see why July contract can't continue even higher, and that's where then you could see like $20 beans. And if you had the Midwest was on fire come June and July, I imagine $10 plus corn or $20 beans is not out of the question. But that narrative is going to have to continue in that direction. And I think since we saw basically the starter's pistol from our quarterly grain stocks and from the acreage assessment, that began last year, this rally. The WASDE report then really started off for the soybeans. But if you look at corn last year, same idea. It started from quarterly grain stocks, blasted off. Exact same idea. Take into account, and we're going to segue into corn here, May corn doing a very similar thing, that if it's going to blast off, like it did last year, it's setting up to, and we have, I think, some very clear levels we can define for risk. That if we go below, maybe we're still in this range, or that's not happening. But if we do start to go above, that could be the clear indication that positionally day over day, a swing trade could be entered for a move higher. So I'm looking very, very intently here. Corn, wheat, and beans. I think we're within a day or two, if it hasn't begun already, of seeing that. And WASDE is going to, I think, affect that and help. I think a more bullish WASDE, we're certainly starting to price it into the charts, because since our quarterly grain stock assessment here in the last chart, or the last news event, we've seen a bit of a rally. So the market is anticipating, I think, those balance sheet cuts, both on the global scale from a reduction in South American production out of the USDA, as well as smaller carryouts and a reduction from our prior month report in both the corn and the bean carryout. I think that is going to be a big factor here. It's going to be interesting to see if they do any kind of shift in the acreage number. Obviously, the USDA gave us the survey data that they collected from farms and from their survey data participants. So the data we already saw in acreage was not from the USDA and what they think it's going to be. It was purely survey data, right? What they were told. So take it with a grain of salt, right? It's important to know what data you're getting, where it comes from, how it's collected, because that at times can be more important than the data itself, because there can be biases and perspectives that you need to extrapolate from that help you, the trader, or you, the analyst, better determine what is going on or what that data means to you. Okay, so corn last year in the May contract here, or this is May 22 corn. That kind of wrapped up beans on the daily time frame. I guess I shouldn't be so quick to move on to corn. We should dial down on the beans and take a look at the smaller time frame here, because I think today we saw a move that could be suggesting, and you do need to keep things moving here, because we're getting, how much time I'm into it? Only 18 minutes in. Okay, so I should have plenty of time. All right. May beans breaking out of this trend line against the highs, I think, is a very important technical move today. It takes us back up into the old range. You see this cluster of lows here that we had in the 620 to 645 area. We're now back above that area on a daily close basis too. So that's another important factor here. It's not just getting up here and fading off of it. I mean, certainly we could turn back over and roll over. We've seen that kind of price action happen before, but the breakout that I think we're seeing of this level so far, the move higher, is an important one to continue to monitor. And I think we're going to continue to see this series of higher highs and higher lows play out on the daily chart now for the May beans. I think we've went down to test the low end of the range. I think now we're going to be testing back towards the high end of the range, and that gives us every ability to break out of that said range if the market wants to here going forward. Going down to the 15-minute time frame, or I guess let's step back. I'm still using the pull, the highs to highs extension. That's from 1421 up to new highs. That is at 1590. We came back down to test that area as support yet again. You could say that this is, for all those Elliott waivers out there, this has been an A, B, C, and then we've got a D and potentially an E wave of a triangle. That D and E wave could all happen in whipsaw surrounding the WASDE report. Could happen in whipsaw into next week. But that would be, very a drawn out range here can't be ruled out is what I'm getting at for soybeans. But I do think from here we have a better chance of going above, testing back towards $17 and maybe even above than we do of going back below 16 at this point in time. What was I about to go to? Oh, yeah. So the same anchor new high that we are trading in, it's a highs to highs extension. It's the second time this pull has potentially traded. I'm using like a 1430 high. The idea is that there is some kind of pullback here a couple times, once, twice, now a third time. That's building that series of higher highs and higher lows. And so this would be the one time it traded. It went up to its technical targets. Same anchor, new high. You just kind of drag it up. So the 50% line, 61 lines, whatever, are holding. The supportive area, the 50 to 61.8 line supportive area is holding. And then now a swing higher would take us towards negative 23.6 or negative 61.8 upside targets, potential targets. So breaking above this near-term trend line certainly suggests that the downtrend that we began from this high in late March, has ended, and now we are in a swing higher for April. On this chart, I am going to be aware, and we're going to be very aware that this $17 to $17.20, where that trend line is, could be a very strong resistance zone. So we'll watch for that here on this way up. It looks like off of the lows, we were tracking a potential 50% short, off the highs here. There was definitely 50% that were holding. So all of a sudden, there was some kind of short selling algorithm that picked up on the market. Here's a great example of the 1736 high to the 1622 low. I'm not saying this is one I would have put up on the chart and taken, but it's certainly one I put up on the chart and acknowledge, that definitely traded a 50% short from the 50% line down towards its negative 23.6% target, right? Drawing up the next in the series from its entry high to the next target low here. You can see the initial reaction from this selling area, or where we'd expect to see resistance, but now we've broken through. So now that we've gone through, we expect to see maybe a 50% pullback. We're a buyer in the dip, but 614 to 620 here would be supportive for the May beans. If we get down though onto even the smaller time frame, 50% swing from now this near-term 1614 low to today's high, 1633 to 1635 is going to be potentially supportive, and that's some place that I will be watching here closely over the next week or so. What I'm saying, next 24 hours into tomorrow. But generally speaking, I think if you do see a bigger dip, look for a pullback towards 1614 at this time. That could change based off where the high kind of forms here, but I don't necessarily believe we should see price action get below $16 again here. So let's take a look at that corn. We saw how on a chart earlier we've got this kind of pennant flag situation going on, a bullish structure that if it's like last year and we break out higher, it could be good for a $2 rally in the corn. 18-day moving average, we are back above it at 748.5. That's awesome to see. That 750 figure seems to be an area the market is liking to trade on. Has traded on the boat, better on both sides of, but has been using now as a supportive area in the short term for, I think, what is now another kind of basing for a move higher. 695 is our 55-day moving average, 100-day down at 650, the 200-day down at $6, and all three rising well here. Went into a little oversold condition, and the market's starting to bounce and come back up. Very clear line in the sand that the market needs to break out of the 757 or 775 area, and if it does, let's take a look on the smaller time frame charts here. My smaller time frame, I mean, we're going to a 4-hour chart, right, for May corn. Let's take a look at where some of these swings could take us. We're seeing trend lines against the lows, okay, continue to hold. So, watch those and monitor those. Corn likes to, go and test the trend line and break through it and then come trade a back above it. So, I need to see closes below, and then not only close, but a break below, and then it move back up to test it as resistance, and then a fall back lower. That's usually my telltale signal that that trend line has been broken. That's not what's going on here. This is the market comes down, runs the trend line, anyone using it stops, and then bounces back up. If you drew trend lines against the lows here over the last couple of days, today's price action was exactly that, and it was a gotcha trade, and now we find ourselves back to highs. Corn loves doing that. It did it all throughout this last couple months, did it all throughout the last rally, and every time corn makes a new high on the week, month, or contract, it seems to like to give a pullback. It's just funny how watch all of those time frames for signals for a pullback for corn. So, going back up to 768, making a new high, there'll probably be one pullback before a move higher within a day. Look for that type of price action. I believe we already had that dip in the corn. We had 3 waves down in an A, B, C correction down into the 714 area. 50% retracement from the 655 low to the 782 high is equal legs and full 50%, as well as this swing, this trend line higher right into 720, 715. That was such a beautiful level that traded there. Actually, on my son's birthday, on March 29th. Crazy. With that being said, we have open gaps at 690, 655, and 622 on the chart still, so very bullish. This seems like a big bullish structure. In my opinion, if we basically traded into this range, a 650 to 782 high to low, and this range is only pulled back that, if we extend that distance from the lows we just made, that has an upside projection of about 840 in this leg higher, and that's just an equal legs here from 660 higher. Now that could get a lot bigger depending on where you determine the swing higher and up into this range began, but I think conservatively getting to $8 where the 50% and the negative 61.8 line from both the equal legs down and that 50% line are. So you've got that 805 and 812 kind of big target area to the upside, extending all the way up to 840 and even above for May corn. I think we're going higher here, but you can't rule out more sideways price action inside the range we've been trading. But once we do start to break out, I think there's the lines in the sand, literal trend lines and lows for the month and trend lines here that I think you can draw and use for risk. Now, okay, that doesn't mean you have to come in with futures, right? I think, and something I want to hop into now, other than maybe taking a look at the 15-minute chart here for corn, pretty choppy sideways price action over the last few days. But this is more or less, I think, 2 steps forward, 1 step back into full 50% or 61.8% retracements. Yeah, it got a little sloppy there, but then it bounced up higher, drawn from the lows of the month here to the highs of the month. This can all be, this price action here on Thursday, Friday could all be attributed to end of month, end of quarter, end of week type of price action, because then here you see the lows for the month of April sticking at 730, drawn to the highs of 768. The full 50% retracement at 750 is holding, and we just broke above, just broke above this trend line resistance as well, where we should expect to continue to see the market trend higher after that type of trend line break, as we are respecting trend lines against the lows, breaking trend lines against the highs. all the cruxes of a bull trend. Upside targets now 776 here from the 15-minute chart, 780 from the hourly chart, and 805 and 812 from that 4-hour daily chart for that May corn. So, okay, so I don't think the market's necessarily taken off yet. I think that there's a strike here at the $7.80 to $8 area that could be owned, a call that if we go above that level, we want to see this market, head higher. And that means that if we go, let's take a look real quickly over here at our options. The May corn, actually, let's go to July corn. We're going to use full data July. We're going to use that $8 strike. It traded for 29 cents there, going out the end of the day. Bet you can get, you can turn around and get a dollar call spread. Buy the $8, sell the $9 here for 19 cents. I think that there's value there. That's a 5-to-1 risk-reward ratio. And if the market does break out higher like we're expecting, going to the $8 to $9 range is definitely going to be in the money here. Plus, over the next 78 days, there's going to be plenty of opportunity to buy back that short $9 call here where you brought in 10 3/4 cents here to do so. I do think there's probably opportunity here for December corn. December corn trading around the $7 handle. Look at that $8, $9 call spread here. Cost you 45 3/8 cents to buy the $8 call. It's about $1 out of the money or 90 cents out of the money, but you do have 232 days left on it. It's a great re-ownership strategy to take, try to capture another dollar or get another dollar of upside improvement, all for the cost of 45 cents out of your pocket for the $8 strike. But that $9 strike, you're bringing in 27 cents. And that, just my quick mental math here, is going to be, what, a 28-cent cost? No, 18-cent cost, right? 45 minus 27. Yeah, what am I saying? So an 18-cent cost there to own the dollar-wide call spread for December corn. It is, again, 90 cents out of the money rather than, only 40 cents, but 40, 50 cents. But nevertheless, you get that much more time on the clock. I think that's a great way of going about getting some of that potential downside protection. And it's worth noting here too that owning put protection below $7 for a move, because I do think if we go below $7.20 to $7 here, we could see a move down towards $6.20 and below. So it might make sense if we want to own some put protection between now and July, if we don't think the market's going to continue higher, or we do think we're going higher. Use that $9 strike in corn here for December corn. Sell that $9 call, bring in 27 cents, and then turn around. That's in December corn, right? We're selling a $9 call in December corn. That's $2 above where we are. We're bringing in 27 cents. Then I want to turn around and I want to use the July on December, okay, puts. And we can spend that 27 cents here, just letting you know where that even money call spread is, or we can own a put here. We can own a put here outright at $6.80. It looks like for that 27-cent out-of-pocket cost. So an interesting even money spread there. However, you have to realize you are, kind of gamma spread between your July and expiration and your December expiration. But you do have the underlying December strikes there working for you. So you'd be long a put, short the market from 680. You'd be short a call from potentially short the market from $8 or $9 above, giving yourself a pretty tight, I think, risk, considering December corn's at 709. You have a 30-cent stop in the market for even money cost for selling that $9 put or call to buy the 680 here. Again, you're doing that because there's time value difference there. but nevertheless. And likewise, I think in the soybeans, here, let's take a look back at the chart real quick just to get familiar again with where the beans are kind of trading real quick and what their range looks like. Um, anything above $17 gets aggressively higher. We might be able to bring that down to 680 to 17. I mean, you certainly could over last week get as low as 1650. I was rolling all of our calls that we had bought, the $17 to 1750 calls that we owned. I was rolling those down to 680 and 1680 and 1650 this last week. Glad we did that. I'd still try to get the 1680, maybe $17 calls done. So let's see how those are pricing out here today into the close. I'd probably going here out to July to give us 78 days left on it. And give you plenty of time on the clock here. Maybe the June option, but nevertheless, the 1680 call here in July, pretty expensive at 46 and 3/4 cents. But look, we can turn that into for about 30, forget it, just bring in 20 cents here for selling the $18 call. So a $1.20 wide call spread here for about a 26 cent out of pocket cost to own in July. I like that a lot. That means if we start to go above 1680, we break out. We got to go above $18 before you get worried about that short call. But the truth of the matter is you're making a $1.20 of improvement here over that time frame. So if we see that move to the upside, there you go. I really like the 1680 $18 call spread here for the beans in the July timeframe, giving you $78 going further. All right, so we don't have much more time left on the clock here today. There's so much else to cover and talk about. Really quickly here, I do think wheat is trying to base and find a bottom here around $10. There's not much else to say that we have started to break trend lines. But I've seen this kind of meltdown on charts happen before. We are staying above this kind of 9 to 950 breakout area where the market was holding resistance before the Russian invasion. So now that we've come back down and we're holding that as support, that could be the market finding a new normal. And a move back towards $12 isn't out of the question because let's face the facts. That is still just a 50% retracement from highs to lows for this swing for the wheat. And if you take even a step further back, you can see that wheat really is only pulling back into some degree of a 50% level itself for this last swing higher. All right. I did want to touch on crude oil today because I do think it's worth noting that we were taking a look and watching the crude. Let's see, was it this chart we were working with? Yes, perfect. We were thinking maybe the market could be holding a 105 and a pullback. It did not. You see how it went below that 50% level we were looking for into 105s. Once it does that, I immediately draw up the opposing 50% line. Boy, didn't that hold as a 50% short. You need to start looking objectively at the other side of the market at times too. That 50% short held, and it has gone down to its target. So next to the series is highs, anchor highs to lows here. Crude oil now breaking below this trendline support. A 50% retracement at 101. If you can't break above 100 and 101 and prove to us that it can get to 103 basically, I think crude is going to be heading lower here. And we need to be aware of that in the near term. That equal legs down now from the 130 swing down to the 93s. Equal legs, if you extend that from 116, that could take you down to an 80. And if you take a really big step back on the daily chart, crude could easily 50% retracement from its lows to highs here on the continuous chart is down around 70, which, by the way, would also be trend line swing against its lows. So big swing and a big move down in crude, perhaps. I might be very interested in being a buyer in that 80 to 70 to 60 area if there is a bigger pullback, which it kind of looks like might be happening as trend lines against the highs do seem to be holding on multiple degrees and time frames. That doesn't even from the that can't mean that is true of both the daily time frame, the 4-hour time frame here, and even the 15-minute time frame intraday. So this does look like a market rolling over. That might weigh on our row crops and anything that's loving this biofuel kind of bid, but we shall see. Uh, let's take a look at cattle and hogs real quick. Live cattle in the June broke below its trend line and channel support, this kind of channeling level channel that we've seen heading higher in the market. Does look like we're going to be making equal legs down. That could take us down to 126. That equal legs lower, all right, could have a full 50% retracement alongside it here. From basically the 117 lows here, the highs after, more or less the contract low, the highs after. So equal legs down and that 50% level as well as channel support from this kind of channel lower. And our old supportive area could be, the cattle market could be finding its way, at least in this June contract, down into that 128 to 126 area. And then maybe we'll see a bottom from there. If we take a step out and take a look at the continuous contract for the fats, you can see the market has been channeling higher. We're coming down into that channel support. We've broken above these old April 2017 and April 2019 highs at 130, 134, and we've gotten up to that April 2015 high. We still have not gotten up to that high from November of 2015 or 2014 there of 171. We need to break above this 140 figure, and then we talk about the breakout higher rates. But so we'll continue to watch this. If you look at the continuation chart here too, we are still below this trend line resistance. So until we break above that, this unfortunately looks like a market that's trying to trend lower. I do think we have a high chance of trying to find a bottom around this 134 to 130 area. Again, that'd be testing these old contract highs. But of course, I don't live and die by that continuous contract. We got to look at the individuals because within the marketing year, they obviously tell a different story about how things unfold. We looked at that earlier with the old crop, new crop spreads for row crops at the beginning of the session, and it's very true of the meats, particularly this time of year when we're going into a time of the year where we're anticipating that summertime demand, and then the processors. Anticipation of it. So lean hogs, highs to highs, 97.70 highs to that 122 high, held in a pullback to 110. You can see this is actually one of the most beautiful examples of a highs to high extension or continuation long that I can show on a chart. Now, same anchor new high after market traded from the 50% line up to negative 23.6 line. Same anchor, new high. We've held support here to 112.57. Hogs have now given us a 2-day potential start to a reversal structure. We're still inside that first that last long-tailed. Would have loved to have seen it being a doji day, but we are starting to begin higher highs and higher lows since yesterday's candle. However, we really need to break above 118 here in the June hogs to consider that to be the case. Otherwise, we could still flirt around and certainly chop around here. Another test of 110 can't be ruled out. But if we do slip below there, I don't see much support again here until we get back down. I mean, really, until we get all the way back down here to this 100 to 99 area. So look out below if we start to slip. But otherwise, I think this is where the support should be, where we would be continuing to suspect buyers to come into the market as they have 1, 2, and now for a third time. Upside swing could take it to 134, an extension towards 145, and then of course if we take a step out towards that continuous contract here for the hogs, it's of course a little more wild than the cattle because of some of those inter-marketing spreads that leave you with these big gaps. But you can see how now this otherwise would be considered a cup and handle pattern. And this is not just a cup and handle, this is a cup and handle that is starting to break out. So if on this daily continuous chart for the lean hogs, if we do continue higher and April, the April through June timeframe rallies, I see no reason why. Take a step back even further. Can't go too far out, I guess. There we go. I don't see a reason why we can't see, if you look at the levels that we're kind of breaking out from right here in this 110 area, couldn't see towards 133 old highs from 2014. But like the hogs here, we need to see cattle break above 140, lean hogs break above 114, 120. I think they are kind of are at 110. And perhaps we're going to be seeing a substantial rally higher. But with all that being said, wanted to catch up on some of the technicals we're seeing today, some of the trends we're seeing unfold. I think that cattle could be a buy somewhere around the corner. I think June hogs might be a buy right here. Wheat markets are sideways here until they're not, but I don't hate strategies that we have on. I know the only wheat strategies that I really have on right now are pretty much sideways based that are gearing up for moves out of a range. Straddles and strangles, and that, those that require maintenance once we start to show a direction one way or the other. This isn't direction one way or the other. This is just let time value decay on your short options, and then pretty soon buy, and then plan to buy them back later. I do think we might be starting to base a move back above 110.74 towards $11 has me wanting to be more of a buyer. I would probably then look to be a buyer using the $12 calls as a strike to own for a move higher for wheat. But for the time being, I'm on my hands for any new positions for the wheat market. I do think corn and beans, though, have given us an opportunity to be buyers and to look for that breakout higher. So we're going to be continuing to look for that. And of course, you ever want to get in touch with me, give me a call over here at Zaner 312-277-0110. That's 312-277-0110. You can find me on Twitter, over here on Facebook at Dan SOTD, or shoot me an email at dhussey@zaner.com. Thanks for joining me today for the Strategy of the Week webinar, everybody. You can join me daily for the Strategy of the Week webinars when our live streams when I host them, or sign up in our links here below to hop on the mailing list to be included for the links and the recordings of this weekly webinar. It's absolutely free. And then also, if you're interested, join our mailing list for our daily newsletter that our team authors here and sends out every day with news updates and market recaps for all of our row crops and meats and other commodities as well. So with all that being said, everybody, have a great day. Look forward to bringing you more price action analysis here, that my life has begun a new chapter. But with all that being said, everybody, have a great day, and we'll be back with you as price action develops. Take care, everyone.